As of 10:10 a.m. Eastern Time on Tuesday, January 13, 2026, JPMorgan Chase Company is trading at $315.61 per share, marking a significant intraday decline of $8.88, or approximately 2.74%. While the broader market is grappling with a shift in sentiment regarding Federal Reserve independence and potential policy shifts, the heavy selling in JPM specifically comes just hours after the bank released its fourth quarter and full year 2025 earnings results. On paper, the numbers look like a classic beat, with adjusted earnings per share hitting $5.23 against the consensus of $4.93, and revenue climbing to $46.77 billion. However, the market is reacting to a much more complex reality underneath those top-line figures. The immediate sell-off suggests that investors are looking past the short-term profits and focusing on a massive $2.2 billion credit reserve the bank had to set aside for its new partnership with the Apple Card. This is a classic example of where the narrative of bank earnings are back meets the cold reality of increased credit risk and rising operational costs. Most investors look at JPM as the ultimate fortress, the one bank that can handle any storm. The expectation was that JPM would simply steamroll through the final quarter of 2025, buoyed by high interest rates and a recovering IPO market. The reality, however, is that their trading desk had a blowout quarter, with equity markets revenue jumping 40%. The core consumer business is starting to show some wear. When you see a bank like this beat on earnings but drop nearly 3% in a single morning, it tells you that the smart money is worried about what comes next. Specifically, the bank is bracing for higher loan losses and navigating a political climate where the government is discussing capping credit card interest rates at 10%. For a bank that just took over the Apple Card portfolio from Goldman Sachs, that kind of legislation could be a massive headwind. It's a moment that forces us to rethink the idea of JPM as a safe haven and start looking at it as a company that is heavily exposed to the shifting sands of consumer debt. This movement in JPM today is actually part of a larger trend we're seeing across the financial sector as we start 2026. While many people have been focused on the massive gains in Nvidia stock or the volatility in Tesla stock, the banking sector has been quietly building up a different kind of tension. If you look at the performance of Apple stock recently, you can see how their service ecosystem is expanding, but JPM is the one taking on the balance sheet risk of those consumers. During the intraday session today, the volume on JPM has been exceptionally high, nearly 4 million shares changing hands in the first 40 minutes of trading. This isn't just retail investors hitting the sell button, this is institutional rebalancing. Some of this capital might be rotating into more growth-oriented areas or perhaps looking for safer havens in individual brokerage accounts or fidelity brokerage options where the risk is more spread out. The core of the issue today is the net interest income outlook. For the last couple of years, banks have feasted on the gap between what they charge for loans and what they pay for deposits, but that gap is closing. JPMorgan mentioned that they expect 2026 net interest income to be around $103 billion, which sounds massive, but it's actually quite close to what they did in 2025. This suggests that the period of explosive growth from high rates is effectively over. At the same time, expenses are climbing. The bank is forecasting $105 billion in adjusted expenses for the coming year, driven by higher pay for employees and a massive push into artificial intelligence. They are trying to build the ultimate digital fortress, but that costs a lot of capital. It's why many self-investing individuals are starting to look at other options, whether it's the ease of use on the Robinhood app or the robust tools provided by the Fidelity mobile app. People want more control over their capital without being tied to the legacy costs of a massive global bank. Let's get into what JPM actually does for a minute, because it's easy to forget how vast this empire is. They aren't just a place where you keep a checking account. They're a massive asset manager, a dominant force in investment banking, and a global leader in payments. Their asset and wealth management division actually had a great quarter, with assets under management climbing 18% year over year. That part of the business is competing directly with places like Fidelity Investments and Schwab Intelligent Portfolios. When people talk about investment help, they are often choosing between the white-glove service of JPMorgan Wealth Management and the automated, low-fee models like the SoFi Robo-Advisor or Interactive Brokers platform. JPM is trying to be both, which is a difficult balancing act. They have the scale to do it, but that scale also makes them a target for regulators and politicians. The bank's history is one of consolidation and survival. They've integrated dozens of smaller banks over the decades, most recently taking over First Republic in 2023. This has given them a huge base of wealthy clients, but it also means they have a lot of moving parts. Their current business model relies on cross-selling. If they have your mortgage, they want your credit card. If they have your credit card, they want your individual brokerage account. This is the same strategy we see from firms like SoFi Investing and Fidelity IRAs. They all want to be the one-stop shop for your financial life. But as we see with the Apple Card transition, taking on millions of new credit card users isn't always a smooth process. It requires setting aside billions of dollars in reserves just in case those people can't pay their bills. Comment below how many shares of JPMorgan stock you currently hold, or if you've moved your capital to other platforms like Robinhood Crypto or SoFi stocks lately. Looking at the broader market context, the drop in JPM today is also a reflection of the cooling enthusiasm for the higher-for-longer interest rate environment. For a long time, the expectation was that the Fed would keep rates high, which would continue to pump up bank profits. The reality is that we are now seeing the fallout of those high rates in the form of higher net charge-offs. JPM is expecting a 3.4% charge-off rate on its credit cards in 2026. That's a sign that the consumer is starting to feel the pinch. When the consumer feels the pinch, they spend less, they default more, and the bank has to work harder for every dollar. It's a very different environment than what we saw in 2024 or 2025. Even with the boom in fixed income trading and the massive demand for financing, the retail side of the bank is a constant reminder that the economy is cyclical. If you are someone who likes online investing, you probably keep a close eye on the competition. JPM isn't just fighting other big banks like Bank of America or Citigroup. They are fighting for the future of how people manage their money. They're competing with the Robinhood trading platform for younger investors and with Interactive Brokers fees for the professional traders. They are even competing with their own tech as they push more customers towards self-investing options within their own ecosystem. The rise of investing sites has made it easier than ever for a person to skip the traditional bank and go straight to a Fidelity trading platform or use Robinhood fractional shares to build a portfolio. JPM knows this, which is why they are spending billions on technology. They don't want to be the blockbuster of banking, they want to be the platform that everyone uses whether they realize it or not. Let's talk about the future outlook for JPM, because that's where the real expectation versus reality tension lies. The market expects JPM to be a steady dividend payer and a safe place to park capital. The reality is that JPM is becoming a massive technology company that happens to have a banking license. Jamie Dimon, the CEO, has been very vocal about the risks of inflation and the potential for market volatility. He's not one to sugarcoat things. When he says the bank is preparing for a wide range of outcomes, he means it. That could mean a scenario where interest rates drop and the bank's margins get squeezed, or a scenario where inflation stays sticky and the consumer truly breaks. In either case, JPM is trying to position itself to be the last bank standing. This is why their tangible book value per share is so important. It grew by over 12% last year, which is a testament to how efficiently they are running the business even with all these headwinds. The institutional activity in the stock today is also worth noting. When a stock like JPM drops 2.7% on a day when it beats earnings, it often means that the whisper numbers, the unofficial expectations of big hedge funds, were even higher. Or it could mean that the guidance for the coming year was just a little too cautious for comfort. We are seeing a lot of activity in the options market today, with people hedging their bets. If you use a sophisticated platform like the interactive brokers trading tools, you can see the implied volatility rising. This suggests that the market expects more swings in the coming weeks as other banks like Goldman Sachs and Morgan Stanley report their numbers. If they also show rising credit costs,